Welcome to Yahoo Finance Live. It's Wednesday, January 25th. I'm Shauna Smith along with Dave Briggs. Let's get you up to speed on this afternoon's market action because as you can see, we are well off the lows of the day. The Dow was off over 400 points, off 460 points earlier in today's trading action, just a couple of hours after that opening bell. You can see we are just below the flat line, off just about 7 points right now. S&P also well off the lows of the day, now off just about 0.1%. The Nasdaq Composite, a lot of those larger cap tech names are under pressure earlier trading. That was causing some of the losses that we were seeing across the board, but the Nasdaq Composite now only off about 0.25%, so recouping some of those earlier losses. Taking a look at the bond market very quickly, you can see the 10-year yield off just a fraction here, still just around 346. Digging into some of those individual movers and starting inside the Dow, you're looking at Microsoft off just about 0.2%. I'll talk a little bit more about that drop that we're seeing more broadly speaking in tech. But I also want to bring to your attention the gains that we are seeing in Boeing. Boeing reported before the bell this morning, despite that miss on both the top and bottom lines. You're looking at Boeing back in the green in today's trading action, trading up just about 1%. Taking a look at some of the bank stocks here, the outperformer Capital One, they reported after the bell yesterday. You can see it up just over 9% today, leading the way. Lots of green on the screen. We're going to be taking a look at the XLF, the financial sector here, some of those larger banks. Capital One, the leader here when we take a look at the S&P, the top performing stock in the S&P today. Taking a look at that sector action there, I mentioned banks leading the way. The financials up just around 0.7%. Consumer discretionary also holding on to gains. On the flip side, you can see utilities by far the underperformer, off just over 1.5%. XLI also off just about 0.4%. Real quick, taking a look at some of those tech names, Microsoft, the drop there, a lot of that having to do with the guidance that initially spooked the street. You can see some of those larger tech names still under pressure today. Dave, we're looking at Alphabet off just about 2.5%. Apple also in the red today.
I think what we learned over the last 24 hours is we rush to judgment with these earnings. We're so in a hurry to break them down and analyze them. We need to give it some time. And that's a warning for Tesla because that comes out after hours. We will see a jump to conclusion.
Yeah, and also just how important the earnings calls are too,
yes,
right?
Two
because
things.
There's so much stuff that goes on in these earnings calls when we hear from executives that really moves the stock the next day or during the trading day if they're before
Patience, my friend. Thank you. Let's get you up to speed now on big tech. Shauna talked a lot about it there, what a difference a day makes for Microsoft. The stock down after it was, well up earlier in the day, but that was not the case when they released earnings Tuesday after the bell. That's when the stock rose 5% after hours initially, after everyone jumped at what looked like a pretty solid report. RBC analyst Rishi Jaluria telling us at the time the numbers were, quote, better than feared. Then came the call and a look under the hood at Microsoft, revenue growth slowing to a 6-year low. CEO Satya Nadella saying on the call organizations are exercising caution given the macroeconomic uncertainty. We got further guidance from their CFO Amy Hood, who said results weakened through December and should further slow in coming months. Again, kind of a lesson to wait for that call. We will certainly analyze Tesla the second they come out and do our best, but you need to give it some time and you need to hear that call before you truly analyze what it means for the next step, the next quarter, the next year.
Yeah, exactly. And or also what it could mean for some of its competitors out there, because initially after Microsoft released earnings yesterday, when there was a lot of excitement about those numbers, particularly what we saw from the Azure, from their cloud division, that actually sparked a bit of a rally in Amazon shares in extended trading yesterday. Of course, the reverse happened today with Amazon under pressure, as well as a lot of the larger tech names or names focused on the cloud because of that guidance number, what we got from Microsoft in the earnings call. Despite all this, despite the concern that we are seeing on the stream, despite the fact that we're looking at some losses today, although you can see we're well off the lows of the day when you're taking a look at some of those larger tech names, the street remains positive on Microsoft. Citi reiterating once again that Microsoft is, quote, best positioned among large cap software names, offering investors a good mix of growth and profitability. We also have Morgan Stanley maintaining that overweight rating there. All right, Microsoft pulling the rest of the market down with it. You can see the Dow still in negative territory, though. well off the lows of the day. Looking at a 2-day chart there on an intraday basis, we are now actually in positive territory in the final hour, trading up just about 17 points. We want to bring in Seth Wonder, Acorn's Chief Investment Officer. Seth, it's great to see you here. So let's start with earnings. We've gotten Microsoft kicking off some of the big tech results that we will get over the coming weeks. We had a lot of the larger banks already report. What's your take on how earnings season is progressing so far?
Yeah, well, thanks for having me. I mean, earnings season, I think at the moment is shaping up as most people anticipate it, which is there's some slowdown in the economy for sure. You see that from Microsoft comments you were talking about just before I joined, that the forward guidance was a little bit of a slowdown. But the reality is we're in a macro-driven market, and people are going to debate rates, inflation, Fed policy, and so forth. And so the idiosyncratic factors will just be small in comparison relative to the backdrop of money flows and how people view risk assets and multiples more broadly. And so when you look at it from that perspective, it's not surprising to see Microsoft rally back materially off the lows, to see the market digesting some mixed earnings news. And I think that's probably what we're in for throughout the rest of the earnings cycle.
Yeah, largely speaking, Seth, are you bullish when it comes to, or are you bearish when it comes to risk on and big tech for the rest of earnings?
I think over the next couple of weeks when it comes to earnings, I mean, every day's got a little bit of something, positives and negatives. So to have a particular view, I think is a bit short-sighted on that dynamic. If you take a longer lens, though, I mean, I think there's something more important going on, which is the reality that the forward probability that CPI and inflation metrics are going to be well below the Fed funds rate. And so we are past the peak of not just Fed moves, but even just absolute rate levels. That's where you start thinking about, like, what does that mean for risk assets over the course of the rest of the year? And if you look at it from that point of view, there's a lot of opportunity ahead of us.
Well, Seth, another thing that the Fed is keeping a close eye on are those jobs numbers. We know the jobs market has remained very strong, but we're starting to see layoffs, which was pretty much contained to the tech sector, starting to spread to various industries. We had 3M in their earnings call yesterday announcing layoffs. Do you expect layoffs to get worse from here?
We need some slack in the labor market, right? So we are basically at 50-year lows of unemployment. So even though there's a lot of like recession talk per se, you still have a reasonably good consumer spending in the aggregate. You still have a very healthy jobs backdrop. And to see companies, I guess, take a little bit of the heat off the edge of the labor market, that is a good sign for forward wage inflation, which is one of the key inputs to elevated CPI at the moment. So I would anticipate, as earnings come under pressure from forward revenue slowdown, for companies to be more prudent with their labor force. But I think we're well away from alarming levels of concern. And quite frankly, I think the probability of a Goldilocks type of outcome is underpriced in the market at this point, which would be the composition of a bit of a slowdown in the market, in the economy, not enough to cause a significant recession, a bit of a slowdown in the labor market, but still healthy enough to drive economic growth and allow for rates to normalize. And that's more likely where we're headed at the moment when you look at how companies are thinking about their employment levels.
Given that setup, what are you seeing from your clients and what are you telling them?
Well, what's fascinating about how we communicate with our clients is really about what you said before, just before I joined, about patience, about having long-term perspectives, and truly about investing over time in the markets. We could talk debate short-term cycles and market volatility. The reality is that the power of the compounding of long-term markets is undeniable when you look at it over 100 years worth of history. Our client behavior has been fantastically consistent and in line with that, where we continue to see investment dollars come into the markets, looking at things on a diversified basis, which is really important, especially now that the bond market has reset to the levels of it as it has. And that gives people an opportunity to look at bonds and stocks in the classic 60-40 sense, if you will, which we haven't had that level of opportunity set for quite a while.
And so, given the fact you just mentioned bonds there, and in the notes that you sent over, you said that you're seeing a lot more questions on yield. What are you telling your clients and your customers about bond exposure and where you're seeing the most opportunity?
Yeah, so I mean, we've been what are we, 15 years or so since we've had, let's call it normalized rates or an opportunity for a bond investor to get the opportunity for price return and obviously interest income. And so we're educating our customer base that that's a nice change from what they're used to. I mean, if you are 35 years old or younger, you really haven't been in a professional work environment and a career earner in an opportunity with this backdrop. So it's a bit of refreshing what the longer term history of market cycles look like, the power of diversification between stocks and bonds, which didn't exist in 22, but really is something that has been time tested before that. And so that educational process, I think, is resonating with our customer base, and I think it's a meaningful story for the vast majority of retail investors.
Indeed, always learning. Seth Wonder, Acorns Chief Investment Officer, good to see you. Thanks. We are just getting started here on Yahoo Finance Live. Coming up, get your battery charged. Tesla ready to steal the headlines when numbers hit in the next hour. We'll be looking at delivery, growth, all-important operating margin, and 3 things you need to know ahead of the earnings call. Then, the Great American Burnout, a new study revealing that more workers are feeling less engaged at work. We don't have that problem, do we, Shauna?
We certainly do not.
See? And House of Pain, home buyers are trickling back into the real estate market as mortgage demand jumps on falling interest rates. All that in the next 2 hours. Don't go away. More anticipated than a SpaceX launch. We're about an hour away from Tesla's highly anticipated fourth quarter earnings release. Senior Autos reporter Praz Romanian will be tracking that story for us. Praz, what are some key things you're going to be watching for later this afternoon?
So first and foremost, the big numbers are revenue, about $24 billion for the quarter, adjusted EPS of $1.12 for that profitability metric. But the big things are stuff like gross margins, right? We had those big price cuts in Q1, so they're not going to be reflected in the Q4 margins, but any indication on guidance will give kind of investors and analysts a peek into what's happening after those big price cuts. People like Bernstein's Tony Sacconaghi, very bearish on Tesla, very concerned about these price cuts affecting margins.
And then I also think the big question there, though, is on the flip side, what it's going to do to demand, how big of a boost that could potentially be for the rest of this year.
Yeah, other analysts are kind of saying, hey, you know what, these price cuts actually will boost demand. We shouldn't worry so much about margins in that case because they're going to ramp up in Texas, ramp up in Berlin. That'll actually help their cost basis and actually make those price cuts kind of palatable.
Really, about 1 million questions for the call. On the top of your list, what would you, if you had a shot, what do you want to hear from Elon?
One shot, huh? Well,
just one.
If they don't address any kind of discussion about the volume targeting, the deliveries for the year, I think that's something that a lot of analysts are saying. You need to come clean on whether you can hit 50%.
They're up big time, right?
I mean, they had about 40%.
Didn't hit their goals, but up 40%.
Up 40%. But this year will be 2 million vehicles. That would be 50% compound growth rate. That means you're making 500,000 vehicles at every factory, right, to hit that, which I think is a lot to do in a year.
He's not asking about Twitter.
I was just going to say, I
all
think
I
what a
wanna
lot
hear,
of people
man.
want to know is Twitter, whether or not he's going to name a CEO, what the timeline, I guess it's more so the timeline of that in terms of, and also just how much time he's spending on Twitter versus how much time he's spending at Tesla.
It'll definitely come up, at least in the analyst portion. How committed is Elon Musk to Tesla right now? How much time is committed to the company? Because right now it doesn't seem like he's there that often, right? It's Twitter. There's launches at SpaceX in Texas, right? How much time is he devoting to Tesla? Is he even going to be on the call today? I think he will be, but he hasn't actually committed or said anything as far as I know. So that's a big question they'll be asked about him. How committed is he? Is he going to sell any more stock? I mean, that's a big story for people too.
Huge question. What about Giga Nevada? What do we know?
So Giga Nevada right now is doing the batteries and powertrains, and they just announced yesterday they're going to make a new facility in northern Nevada near Reno to actually build some more batteries, but also some semi-trucks there too. So that's sort of a big news yesterday, $3.6 billion plant there. So kind of a big deal, actually, from that point of view.
Certainly is a big deal. You're looking at Tesla shares up just over 1% ahead of this report. Pras super median. Thanks so much. And if you want full coverage of the Tesla earnings call, you can catch Pras along with Brad Smith and Brian Sazi for their live after the call special this evening. And speaking of Tesla, it appears that the company's CEO, Elon Musk, may not be done looking for funding for his other project, Twitter, what we were just talking about here. The Wall Street Journal reporting that Musk has, quote, been exploring using as much as $3 billion in new fundraising to offset some of the $13 billion in debt owed from the Twitter transaction. But fundraising from outside investors could be tough. The Journal pointing out that Fidelity, which backed Musk's takeover of Twitter, wrote down its stake by 56% in November. Now, Musk responded to the claim on Twitter. When asked by a user if the story was accurate, Musk simply wrote back, quote, no. So perhaps there's some discrepancy on whether Musk is really seeking some more funding for Twitter, and then, of course, how much money that might be. All right, well, coming up, fun fact, the Cheesecake Factory's menu is over 20 pages long, contains over 250 items. I think this place is heaven, but whoever wrote it must have been starving. Cake shareholders are not too happy, though, today. We're going to tell you why next. Time for Triple Play. 3 stocks that we're watching in the final 30 minutes of trading. We have Capital One, Cheesecake Factory, and Sunrun. Kicking it off today is Capital One. The stock rising. It's a top performer in the S&P. Now, the street applauding the company's move to set aside a higher than expected loan loss provision. So Capital One setting aside $2.4 billion. Putting that in perspective, that's about 30% more than what the street was expecting. In a note to clients, BMO writing that Capital One is doing what its peers have not so far this earnings season, and that's positioning itself appropriately ahead of the credit cycle. Now, Capital One also posting an increase in the fourth quarter, driven by higher net interest income and non-interest income. You're looking at gains of just about 9% today, so certainly taking some of its competitors with it to the upside. Brook Financials, the top performer sector-wise in the markets today.
Yeah, now, Sean, it's important to note here that this rally does come after the company announced layoffs just last week. That actually impacted their IT department. Now, that is unique to Capital One. It's not something that we're seeing at the larger, widespread layoffs. So it's currently sweeping across multiple sectors. In that layoff round, they did let go of about 1,100 employees. So quite the day for a rally. Important to note that here. I'm currently taking a look at shares of Cheesecake Factory. They're recovering up about nearly bordering the flat line there after UBS downgraded the stock from neutral to sell, causing shares to fall nearly 4% at market open today. In a note to investors, UBS warns against the year-to-date rally on shares of the fast casual chain, up more than 19%. The firm said it expects same-store sales to slow down at Cheesecake Factory and for higher food and labor costs to take a toll on the company's bottom line. UBS did also cite macroeconomic headwinds like the risk of a recession that could negatively impact casual dining demand and has increasing concerns about consumer spending, making Cheesecake's future outlook uncertain. I also do want to note here that UBS did maintain its price target of $30. We're seeing shares slightly higher than that today. And as of this morning, Wall Street has 3 buys, 9 holds, and 4 sells on shares of Cheesecake.
This on the heels of another downgrade from Citi just last week, but largely speaking, investors not buying it based on that. Yeah. And look, I don't want to talk about the stock. I just want to talk about Cheesecake Factory. Are we bullish or bearish? Because I love me some Cheesecake Factory.
Oh, you do? I thought you were.
Love it.
I love it too.
Oh, you thought I was down?
I thought you were down on cheesecake. I thought we've had this.
I think that there's a little bit too many menu options. If I'm being honest, it's hard to choose.
You can find anything you're looking for.
You can find anything. It's good for a big group.
As a former restaurateur, I would shrink that menu. Yes, that is hard for ordering and the amount of food you throw out. But don't you ever throw out the Bang Bang Chicken and Shrimp, which is one of the greatest meals I've ever had.
Dave bullish on the Bang Bang Chicken. Noted, noted.
And their salads are very good too. My only issue is that it is a bit pricey for a chain restaurant. When you take a look and you compare some of those menu prices to maybe some of its competitors, and this was noted in UBS's note out this morning, that it is more expensive. So that is my one issue. If they could bring it down a few bucks on every item, I think I would go a little bit more.
Inflationary customers, but you get leftovers, man. It's so big. It's like the size of my,
a lot of calories in those.
What could happen here is if consumers do pull back a bit, they could be pulling off of those fast casual chains and they could be going to more McDonald's.
They could go to Dave's Hot Chicken. We have the founder and CEO coming up later in the show, fastest growing restaurant chain in America.
The chicken looks good.
Tease is what we do here. My play is Sunrun. Barclays sees cloudy days for the solar company ahead, downgrading the stock to equal weight from overweight and cutting the price target to 35 from 44. Barclays saying in a note, quote, U.S. residential growth would be in the mid-teens range this year, but could be more muted in 24. The Inflation Reduction Act, which President Biden signed into law last August, authorized $391 billion in spending on clean energy and climate change initiatives over the next decade. But Sunrun has not been able to capitalize on that for the most part, now down more than 8% over the last 12 months, falling nearly 8% earlier today, and now has rallied a bit, still down more than 6%. The Invesco Solar ETF did see that upside, though. They saw it all, raising more than a quarter over the last year. It fell with Sunrun and basically the whole solar sector today. It's interesting. I equate this, and I talk a lot about the CHIPS Act, as you know. We all thought chips would benefit in the short term from the CHIPS Act. They did not. And for the large part, we saw the same thing with solar, and why they think that, the theory is, Shauna, is that it was a 10-year window. So the consumer knows, I have 10 years to do this and still take advantage of the tax benefits. So why would I rush out and do this when it's spread out over 10 years, not as much of an incentive?
Exactly. And also it could be a pretty costly decision too, just in terms of the cost that you're paying up front. So in this economic environment, and when people are pulling back on spending, maybe they're not as willing to kind of cough up all that money up front in order to move into this space. But I think it's interesting when you take a look at the street's overall ratings on this stock, because of that weak performance in 2022, what you were talking about, there's still 19 buys when there's so many questions just about the uncertainty of the next couple of months, couple of quarters, at least. When you take a look at the fact that shares are just around $24 a share, I wouldn't be surprised if some of those 19 buys were downgraded to holds over the coming weeks, given the clouded outlook that we will likely see from Sunrun.
Yeah,
I'm stuck on cheesecake. I really.
It's hard to follow.
My brain turned off.
We were struggling today with our picks.
We didn't even have any cake. We just talked about it.
Exactly. I was lucky. I got to go before cheesecake.
Yeah, Brooke, thank you for playing, and thank you for working with my imagination today. Coming up, many happy returns. The first ever ETF turns 30 years old this week. We're throwing a party at Cheesecake Factory. We'll also look at an investment vehicle that has changed the way millions invest, and it's still evolving. That's next. Some 30 years ago, the Spider SP 500 ETF launched, becoming the first ETF listed on U.S. exchanges. It began with $6.5 million in assets and has since become one of the most successful to date, topping $354 billion, with the ETF industry as a whole approaching $10 trillion. We'd like to bring in Jeff Spiegel, BlackRock head of U.S. Megatrends and International ETFs, in this week's ETF report brought to you by Invesco QQQ. Good to see you, sir. 30 years. Happy birthday to ETFs. Biggest change, you think, over those decades?
Happy birthday indeed. Thanks for having me back. I would say the biggest change has been giving investors more choice. So if we think about the start of the ETF vehicle, we're talking about the S&P 500, we're talking about US large cap. Then we moved into a period of getting to US small cap ETFs, of emerging markets, of developed markets. We went more and more granular. We broke up US markets into 10 or 11 GIC sectors. We broke up international markets into 40 plus different countries. So the first sort of 20 or so years of the history of the ETF has been getting more granular. What I look after here at BlackRock in megatrends is sort of one of the newer innovations of ETFs, which in some ways is going broader. When we think about indexation, we think about rules. How do we bend those rules a bit? How do we get more creative to capture themes, say clean energy or electric vehicles, across a value chain that breaks traditional geographic boundaries or sector boundaries or style boundaries? All of this fundamentally is about giving investors greater choice. And we couldn't be more proud at iShares to be the #1 choice of investors as the largest ETF issuer in the world 30 years after the creation of the vehicle.
So Jeff, given the success, given how much money has been put into ETFs, what the industry is approaching 10 trillion in assets as we head into this year. When we talk about some of those thematic strategies, what you were just talking about, the next 30 years, what do you think that holds for the ETF industry?
I think it holds more and more creativity. Megatrends, which is our sort of view at BlackRock of the long-term structural forces transforming the world, is a range of ETFs that we build focused on technology and demographics, urbanization, climate change, the rise of middle-class consumers in emerging markets. As those innovations continue to evolve, our commitment is to keep delivering ETFs so that investors can say, at the cutting edge of innovation, at the cutting edge of transformation. But if you think about a megatrend of today, maybe it's cybersecurity, maybe it's robotics, at some point that'll become a traditional industry. We'll be looking to another megatrend. 50, 75 years ago, aerospace or rail would have been a megatrend, and then it just becomes a traditional industry. So we'll see the proliferation of traditional industries, but at the same time, we'll keep pushing forward to make sure that investors also have long-term structural growth themes, areas of innovation and transformation in the economy in the ETF wrapper.
And in the next year, those we're talking long-term transformational type project, but in the next year, we're still looking at a rising rate environment. We're still looking at a lot of projections of a basically flat ETF, S&P. What are your projections over the next 12 months or so?
So in our outlook for the year, what we're really focused on is the return of dispersion. If you think about 2020 and 2021, when it seemed like no matter what you did, markets were up, and 2022, where it kind of felt the opposite, like no matter what you did, markets were down, they seemed very different, but actually have a really important commonality. And that commonality is dispersion was incredibly low. Stocks were just moving together. What that means this year, with dispersion already returning significantly, is investors have to get pickier. They have to be more thoughtful about what exposure they're looking for. And there's really 3 areas that we would highlight that we think investors can benefit from, even in this environment. The first is areas where we know money is going to be coming from government regulation and legislation. That's clean energy and electric vehicles, or tickers iClean, ICLN for clean energy, and iDrive, IDRV for electric vehicles. It's areas with near-term breakthroughs like genomics, mRNA vaccines, like neuroscience. Major breakthrough just approved against Alzheimer's, tickers there, iDNA and IBRN. And then last and certainly not least, even though some investors have been shy in technology space, we think that robotics, because it's literally combating many of the supply chain challenges today through making labor more accessible, supercharging in the midst of a shortage of workers, and cybersecurity, which has really moved from niche to necessity. It's not something that can be cut in a downturn. And the tickers there, IHAK, IHAC, our cybersecurity ETF, and IRBO, our robotics and AI ETF.
All right, Jeff Spiegel, great to have you. BlackRock, head of U.S. Megatrends and International ETFs. Well, coming up, new frontiers. Microsoft's making a big bet on ChatGPT. But are its bread and butter businesses getting left behind? We will discuss the AI space with the Hype Machine author Sinan Aral when we come back.
Shares of Microsoft were down pretty considerably early in the day, but now largely flat, and shares of Google down nearly 3%. As we found out, the road ahead for big tech looks a bit bumpy after Microsoft earnings report. But Microsoft may have the decided advantage right around the next corner. The company betting $10 billion big on OpenAI and specifically ChatGPT. CEO Satya Nadella is saying its impact will be, quote, at the magnitude of the personal computer, the internet, mobile devices, and the cloud. Sanan Aral is the director of the MIT Initiative on the Digital Economy and the author of The Hype Machine. Nice to see you, sir. How considerable do you think that advantage will be for Microsoft?
Well, I think time will tell, but I think it's an excellent bet. $1 billion to start, $10 billion to follow on in the investment. And as we have seen recently, it has Google shook a little bit, calling a code red, calling big names back to the company to talk about it, to think about strategy. And there's a good reason for that. ChatGPT is potentially an existential threat to Google's business because Google relies 60% of its revenue on search, and ChatGPT offers an alternative to search, which is a one-stop question answering shop powered by AI. Microsoft has been struggling to compete on search with Bing, although they've been doing better over the years, but this could change the game of search entirely, which is core to Google's business.
So Sanan, if you were talking to Google right now, Google's trying to figure out how to get that edge back considering this massive threat from ChatGPT. What should they do?
I think there has to be a combination of investments in external players as well as internal investments to refocus and streamline their approach to AI. Obviously, Google is no slouch in AI. They have some of the smartest minds in deep learning, machine learning, and statistical modeling. However, their applications of AI have not been competitive with things like ChatGPT. And if you think about ChatGPT and generation or generative models more broadly, we're talking about text and images and even computer code that can be generated by machine learning technologies. And after GPT-3, there will be 4, 5. Imagine what GPT-10 looks like. You could see it replacing all sorts of functions in tech, and that's why it's such an existential threat. Investments externally, investments internally, streamlining and focusing the approach to AI inside Google.
Going to transform just about every industry, including education. ChatGPT passed the U.S. medical licensing exam, the bar exam, and got a B on a Wharton MBA paper. You as an MIT professor, how is it going to transform the entire educational practice?
I think it is extremely disruptive, but potentially in a good way, in that we have to learn to teach differently. We have to learn to race with machines instead of against them, to use the words of Eric Brynjolfsson and Andrew McAfee. And the New York City public schools were trying to ban the use of these types of language models. I don't think that's the right approach. I think what we have to do is we have to change the way we educate. We have to reskill and, based on our education, focus on things that complement artificial intelligence rather than try to compete with it or ban it or slow it down. It's potentially a way to enhance and augment and scale creativity, but it has to be used in a way that's complementary with human skills. And that's going to be the next challenge for the labor force as well.
Sanan, talk about real quick just the flip side of it, because there still is, there certainly is a lot of fear out there just about what this could do, not only to the education system, what it could do for jobs and the broad implications of this technology.
Well, we're experiencing one of the greatest upheavals in the labor market that we've seen in a long time. You can imagine human history punctuated by several of such transformations: the agrarian revolution, the industrial revolution, and now the information revolution, which is essentially an accelerated exponential change at the current moment, even compared to 20 years ago, with the advent of large language models, scalable machine learning, and AI. That is the story of our time with regard to the economy, and it will displace jobs. It will create what's known to economists as skill-biased technical change that favors some skills and complements some skills and substitutes for or competes with other skills. And every time in human history that we have experienced something like this, we've had to reskill and change our focus on what humans did and what machines did in order to create complementarities and increase welfare across the board. And that's what we are challenged with doing today as companies, as policymakers, and as workers.
Sinan, it was my hope that my kids didn't really know what ChatGPT was. Boy, was I wrong. They laughed. They said all their friends are using it. I'm not sure how. I'm not sure if they're cheating. What would you tell parents? How should we handle this? The fear is our kids are not only cheating, but their inability to form their own opinions is in jeopardy. What should we do?
It's funny you asked that. I was going to say that they probably knew before you did, as I'm sure that my nine-year-old knew before I did. As the father of a 9-year-old, I do not want to scare him away from this type of technology, although we have strict limits for screen time at our house. I want him to play with it. I want him to experiment with it. I want him to understand how to use it. I want him to think about how he might work with it, rather than try to keep him off of it or to keep him away from it. We have to learn how to use complementary technologies like this to aid us, extend our creativity, to scale human thought. And I think that starts with young generations. Frequently, they're the innovators. We're the laggards. Maybe they should show us what we should be doing with it. Certainly, cheating should be something that you parent away from at all times from an ethical and moral standpoint. And that using technology, not to cheat, but to knowingly and transparently address the technological revolution is the right way to go about it, in my mind.
There's some great tips there. And Sinan, my kids are a little bit too young, but I will keep a lot of that advice in mind in the coming years. Sinan Aral, thanks so much.
Thank you.
Well, sticking with ChatGPT, talking about experimenting with it, figuring out how it works, we are going to take a closer look at this and then also about the information it spits out. We want to bring in tech reporter Ali Garfinkel. And Ali, you did just this. You had a conversation with ChatGPT. You interviewed ChatGPT. What was it like?
I did, Shauna. You know, as this has been going viral, people have been fascinated, obsessed, scared. I have been all three of those things. So I decided to ask it why. I should say others have done interviews with ChatGPT, but I had some questions of my own. It got pretty existential, but I wanted to just draw out three things that were really striking through the process. The first, number one, is actually pretty simple. ChatGPT can't be on or off the record. This actually caught me a little bit by surprise. I was like, well, technically I'm defying my programming. Can I publish this if it's not on the record? The conclusion I came to, as you can tell, is yes, but it certainly presents other problems. Like, for instance, I think what I was expecting was that it would say, I am always on the record. I am a machine learning model. Though as it turns out, it can be neither. The second thing that was really striking was that to get good answers, you need to learn to talk to ChatGPT. We can't just talk to ChatGPT and say, hey, why are we fascinated by you? Or, hey, what do you think of this? It's not going to give you personality. It's not going to tell you what it thinks unless you give it a little bit more color, or unless you tell it what personality to give you. The way a human would say, bring you personality, whether you liked it or not. ChatGPT will actually respond to the personality you ask it for. Since, Shauna, I know you love Reese Witherspoon, I asked it to impersonate Elle Woods seeing ChatGPT for the first time. And this is what it came back with. It features phrases like, you got this. And it's like your pink highlights bend and snap. It was really cute. It was really cute. I was charmed by it. But that said, the third thing that's important here is that despite how impressed we are with some of the creative work ChatGPT was, I actually found its limitations to be substantial, particularly when it comes to these kind of creative tasks. For instance, it's not putting songwriters out of business anytime soon. I've had it do a couple of songs, but in this particular case, I asked it to provide the lyrics to a song by The Clash, and it couldn't complete the response. Actually, to date, it is the only thing I have asked ChatGPT where it couldn't give me that response. So though there's a lot about ChatGPT that is awesome, is interesting, it's certainly not the easiest interview I've ever done.
And you had ChatGPT answer a question on my behalf. What was that? How'd it go?
You were interested in asking about the jobs question, what kind of jobs ChatGPT is possibly coming for. And ChatGPT was a little defensive. What it was saying is, these are jobs I can help with, these are jobs I can assist with, but it said it was not coming for those jobs. However, I actually have run this response by an expert who disagrees. He says that there are actually implications for call center jobs, knowledge jobs, entry-level jobs. What we're seeing here, Dave, is ChatGPT spouting the party line, as it were. And I really like this question because it gets at the crux of why we're so fascinated. We're afraid of how it's going to reshuffle our world. We're fascinated, we're afraid, and we're fascinated. And I don't expect that to stop anytime soon.
We need a him or a her. I don't believe it. I believe it is coming for all of our jobs, Allie Garfinkel, but I'm old.
Yours
so
too?
I worry for you young people, not us old ones. Allie, thanks so much. Coming up, if you're feeling too burnt out by work to even listen to this tease, then you need to watch this next segment. Somehow worker burnout is super high right now. Just ask the former Prime Minister of New Zealand. The details next.
U.S. employees are getting more disgruntled. A recent Gallup poll finding that employee engagement, which had its first year-over-year dip in a decade in 2021, fell again last year, going from 36% in 2020 to 34% in 2021, and then falling to 32% in 2022. This is for full-time and part-time employees. The poll also finding that 18% of workers are actively disengaged at work, and active disengagement actually ticked up 6 points since 2020. The ratio of engaged to actively disengaged workers is at the lowest rate that we've seen since 2013. And Dave, this is concerning when you take into account workers right now. Employers are doing everything they can to keep the workers that they have because of the fact that the labor market is so competitive. It's hard to hire for the jobs that you need, and those quit rates keep rising. They're incredible when you take a look at the labor market, what those numbers are on a month-over-month basis, and this is a very worrisome trend for employers.
Yeah, but employers don't seem to understand that the world has changed. We've all changed. And yes, like everything else, that's because of COVID. The expectations of workers are different now, and employers have no idea what to do with that. It's not simply using buzzwords that HR pass down to them, that pass on to their employees. They have to learn to be different, to actually engage those employees, to create a different atmosphere, and to be acknowledge the fact that mental health now is of utmost importance. At first glance, Shauna, my guess was this was largely generational. It is the best correlation. Young people are more burnt out or more disengaged than old people because their expectations are frankly different than older people who worked 20, 30 years ago and have a different expectation. It's not as simple as remote work versus fully in office though, and that was surprising to me. The biggest correlation was among those people whose jobs could be fully remote, but were actually fully back in the office. That was the most disengaged group. I thought you needed to be in the office to be truly engaged. The numbers don't bear that out.
The numbers certainly don't bear that out, especially when you take a look at those productivity numbers, really showing that you can be even more productive when you're working from home. You're not worried about commuting into the office, and a lot of people are much happier about that. Clearly, employers need to make some changes if they want to keep the employees that they currently have.
They don't know how.
Those numbers. They need to figure it out quickly, that's for sure. All right, well, coming up, we are counting down to the closing bell on Wall Street. All three of the major averages back in the red. The Dow off 56 points. We'll be right back.
All right, we're just a few minutes away from the closing bell, so let's bring in Yahoo Finance's Jared Blickery to break down the action. Hello, sir. What do we got?
Hey there, we got a market that is in the midst of a turnaround. You wouldn't know it from all that red on the screen right there, but let me show you a couple charts. This is the Nasdaq down about 0.25%. It was down over 2% at the lows there. Huge opening gap. It was filled. That gap I'm talking about also happened in the S&P 500 and I believe the Dow. So let's move on here. I want to take a longer term look at some of these markets markets. This is going to be, here we go, the Nasdaq 100. This is over the last 2 years. The Nasdaq, the S&P 500, the Dow, all trying to break to the upside here. We got some important horizontal resistance. I could show you the Philly semiconductor chart. There's an inverse head and shoulders pattern that's in play here. The bottom line is the coming day, maybe the next few days, including those big Apple earnings next week, really probably going to set the direction for the market in the next few months. Could be up, could be a big squeeze to the upside, talking about this in the morning brief for tomorrow morning, or it could be to the downside. If we roll over, probably going to expect the Nasdaq to lead to the downside. So interesting setup right there. Now let's get back to today's action. Now we have the sector action here, financials in the forefront, utilities to the downside, but I do want to get to some earnings. Earlier today, we had Freeport-McMoRan. You can see the stock is up about 2% right there. That's after they beat on their fourth quarter earnings. And we're seeing that the stock has risen even more since the opening bell there. And that is a beat on the fourth quarter earnings for Freeport-McMoRan. And let's see what they're doing on a 2-year basis. Now, one of the things out of that report is in the US, they can't find enough laborers to actually fill slot positions and to dig stuff out of the ground. So that's one of their hiccups there. Nevertheless, they were able to exceed expectations on the results. And on a 2-year basis, they're in the upper end of that range here. Now, here's a 5-year chart you can see, and they are kind of levered to the gold trade. And we did see that pop up over the last few years, but we'll have to see what comes of this sector. Now, we also want to take a look at Tesla. We have these earnings coming to you after the bell, and here is the behemoth right here. Two of the most important and widely followed stocks are, of course, Tesla and Apple. Now, here's Tesla over the last 5 years. We all know this big drop coming in here. I think what traders are going to be paying attention to is the huge implied volatility that we're looking at. So options traders are looking at a move of either 11% to the upside or to the downside from this price right here. So heading into that report, you add 15 to that, subtract 15 from that, and that's a decent price band. We could see the price head all the way up to 160 or all the way down to 130. At those points, if we reach those levels, I would expect investors to fade that trade. Here's your closing bell on Wall Street.
All right, that wraps up today's trading day. When you take a look at the numbers across the board, we didn't travel too far from the flat line. The Dow barely eking out gains, flipping back into positive territory in the final couple of minutes of trading, up just about 9 points. So the S&P off by a fraction there, just below the flat line. The Nasdaq off just about 0.2%. Let's get into some of the day's top movers. We got to start with Shopify. It was a major winner today. The company announcing price increases to 3 of its plans, and you can see the stock closing up nearly 11%. Now, merchants will now be charged $39 for the basic plan. That's up from $29, $105 for the Shopify plan, an increase from $79. And the advanced plan has the largest increase, moving from $299 up to $399. Indeed, this is a welcome move by the street. Some analysts saying that this was long overdue. True is saying that price increases were due now for quite some time. So that increased by about 30%, 33% across the board for its plans. Clearly, it looks like the street is pretty bullish on that, given what that could potentially do to its revenue.
Long overdue, yes, 12 years since they've increased their prices. But also, to your point there, these are massive price increases, essentially a third across the board, leaving you with that question of how many people are going to ditch Spotify because of that drastic a price increase in this economy, with inflation what it is, with the potential recession around the corner. Initially, I think a lot of people may have to get rid of Shopify, but that's not what the analysts think, because Baird says we don't think these prices warrant a change for the vast majority of merchants, given a couple of things: the time and effort required to shift platforms, and probably most importantly, that Shopify offers superior e-commerce functionality at a reasonable price. KeyBank analyst also agrees that people will not have to leave Shopify again. In this economy, I'd be surprised, though you can lock in the annual prices if you sign on an annual deal, you can lock in the current prices right now.
Yeah, for a couple of months. I think it's also key to look at what some of its competitors have done. Or when you take a look at some of the other names in that space, Intuit, Wix.com, they implemented price increases here already. So the fact that I guess Shopify now just catching up to them, maybe that's why some of these analysts aren't too worried about those churn numbers that you were just talking about. Barrett actually saying that this could add $200 million to subscription revenue for 2023. And they actually see that number rising to $300 million to $350 million in incremental revenue on an annualized basis going forward. So that, I think, is why we are seeing such a jump in the stock today.
It's been a good start to the year for them as well, up 30%, but that stock lost almost half its market cap in 2022, so a long way until they recover. Next up is Boeing, shares teetering near the flat line, slight gain today after the aircraft producer's fourth quarter earnings release. The company's $19.98 billion fell short of Wall Street revenue estimates, while its adjusted loss per share came in at $1.75, more than $1 more than the street had been expecting. Boeing attributed the lagging losses to supply chain issues, while despite rebounding sales and deliveries, again, they point to really some struggle in the supply chain, but labor issues as well, Shauna.
Yeah, jet engines, other components have certainly been a challenge here for Boeing. But when you take a look at the stock reaction, initially, it caught me by a bit of surprise. A lot of that, though, has to do with the cash flow numbers that we did get from the company. They were pretty strong. When you take a look at the cash flow beating expectations, their CEO Dave Calhoun, though, once again reiterating the fact that those challenges, the same challenges that we have been talking about, some of those supply chain issues do remain going forward. Revenue was about in line with expectations. It's also going to be interesting to see what the demand is like from China. We talk about the reopening there, how quickly that could potentially come back online when we talk about their economy going forward. Once that gradually starts to reopen, or the reopening, I should say, picks up more steam, that could be a bullish sign for Boeing going forward.
Calhoun said they've got more big orders in line right now than he's ever seen, and he said most of them are coming from outside the United States. FactSet surveyed 26 analysts, 18 have an overweight or a buy, 7 holds, and just 1 sell. Gives you a pretty good sampling of how investors feel about Boeing.
Certainly does. RBC coming out saying not a lot of news in this, but not a lot of news in this case was good news for the stock. Again, the stock closing up just about 0.3%. All right, let's take a look at AT&T, another important mover to keep on your radar. That stock closing up about 6.5% today. The pop coming after the company released its latest earnings report before the bell. The company produced earnings per share of 61 cents, coming in higher than the street's estimate of 57 cents. But really, it appears to be those subscriber numbers that are pushing this stock higher. AT&T added 217 million total subscribers across all divisions. That topped the street's estimate by just about 2 million. Profit and free cash flow outlook missed the street's expectations, but certainly, Dave, looks like those subscriber numbers clearly the huge headline, and that is what Wall Street is focusing on in this report.
Yeah, John Stankey ecstatic, the CEO, about those numbers, saying this marks the best 10-quarter stretch of wireless growth in more than a decade for AT&T, which is really a shocking number when you consider the environment that we're in at the moment. And for the exclamation point, Stankey says, what's our strategy? It's quite simple. Do it again. So not a whole lot to analyze there. Pretty pleased with their performance, wants to keep it up.
Certainly are pleased with the performance, and it looks like that strategy has been paying off. When you look at the new phone subs, 656 million. It is important to point out that they are offering still some promotions here. That, of course, weighing on their business a bit. They're spending on that 5G expansion. They're spending on the phone giveaways to bring in those new users. That is costing AT&T just a bit, but clearly subscribers, they are moving towards AT&T. We're seeing that reflected in those numbers.
And that, friends, is what's moving the markets today. Coming up, we'll have Tesla's fourth quarter earnings, what's going to move the market tomorrow, perhaps. Don't go away.
Let's get to some breaking news. Tesla shares popping after hours. You can see a gain of just over 3%. Jared Blickery has the numbers first. Hey, Jared.
That's right. We're looking at fourth quarter adjusted EPS of $1.19. Now, that's 7 cents ahead of the Wall Street estimate of $1.12. Also taking a look at the revenue number. That was a small beat as well. $24.32 billion. The estimate was for $24.07 billion. Also taking a look at free cash flow. That is one of their critical key metrics there. That came in a little bit light, only $1.42 billion. The street was expecting $3.13 billion, so a little bit light on the cash flow right there. Gross margin. Here's another stat that the street's keyed in on, 25.9%. Estimate was for higher, 28.4%, so a little bit of a disappointment there. And just looking at some of the other facts and figures here, it looks like they are set to remain ahead of schedule for 50% compounded annual growth rate with 1.8 million cars for the year. So a little bit of forward guidance there. Now, a lot to parse through on this report. And on that note, I'm going to send it back to you guys.
All right, Jared, there are the Tesla numbers we've been waiting for all day. Shauna, again, the margins we're really waiting for is probably a Q1 23 story because we want to see what the impact was of the price cuts both in China and most specifically in here between 7 and 20% price cut. And there were 3 price cuts this year on the primary Tesla models. But again, to Jared's point, the gross margin is 25.9%, well short of the estimates and probably going to get much worse ahead.
Yeah, certainly. And I think a lot of the reaction that we are seeing in the stock, actually right now we are back in negative territory. So flipping between gains and losses here following these results as investors kind of digest the numbers that we are getting. But I think the positive point here that they remain ahead of that long-term 50% growth target here for deliveries with 1.8 million cars in 2023. That is a huge headline here coming out of Tesla. But when you take a look at that revenue number, a slight miss there from the company, $24.3 billion. The street was looking for $24.67 billion. Gross margin number, 25.9%. That missed the street's estimates of just above 28%. That's a bit worrisome here for the company. Cybertruck, Tesla saying that is on track to begin production this year, also saying that they have enough liquidity to fund a product roadmap here going forward. Let's talk about this, what this means for Tesla. We want to bring in Craig Irwin, Roth Capital Partners Senior Research Analyst. Craig, it's great to see you again. I know you've only had a couple of minutes here to look at these results, but what do you think?
So, optically, top line, bottom line ahead, margin miss is not a surprise. The different contributions to gross margin we really need to pick at are the $467 million in credits. That is a very heavy credit contribution in the quarter. Also, we want to see the deferred revenue recognized in the quarter that we have not found yet. But that's, I understand, going to be a fairly chunky contribution given some of the features of FSD that have been rolled out to all the customers that are now using or subscribers to FSD. So that should be a pretty chunky gross margin contribution. Really what's going to determine the direction of the stock tomorrow is going to be margins for the year. The price cuts of more than 13% are pretty dramatic. And I expect they're going to be conservative tonight on what they say about pricing. Once you've taken some cuts, you could very easily take more, particularly when, what do we have? Something like, 90 new EV models coming to market this year. We're going to have 500 globally by the end of 2025. Tesla does face some significant competition and share erosion, and that does not create a margin accommodative environment. So we're still bearish. This was a good quarter for them on a relative basis. 40% growth for the year is still fantastic. But we just think Tesla is overvalued and there's better places to invest.
And let's talk a little bit more about those price cuts, initially heavily criticized by analysts, who then swung around and seemed to be complimentary of them as we saw demand spike across North America and in China. Where are you at on the price cuts today? A net win?
Price cuts were the right thing for them to do. I mean, they absolutely did need to bring the pricing down such that their customers can qualify for the IRA subsidies, right? That was essential. So it was the right thing to do. It's just going to hurt. It's going to hurt margins. It's going to hurt the P&L. And it's going to hurt the longer term earnings outlook. I mean, there's a long tail to margin erosion, and when you're cutting price, it makes it harder to raise price. They are the leader in the market, so it's possible we could see them raise prices a little bit. They did raise prices in China by about $500 within the last week as inventory came in line. But I'm a believer that we're going to see continued price pressure as overall share pressure is an issue with many successful alternatives coming into the market.
Well, Craig, here we are today, Tesla just around a 2-year low. You talk about some of those downside risks. How much more pressure do you think we could see on this stock?
So my price target's 85. I believe for a long time, I've kept that about 2 years. I believe for a long time that Tesla should not be valued more than Toyota. I don't think there's anything that Tesla has that Toyota does not. Toyota did something like 9 million cars last year. Tesla 1.4, fantastic. But, on a relative basis, I think people need to be careful. There's great names in EVs. Tesla is a great name in EVs, but I think the money is more easily made elsewhere.
And of course, when you talk Toyota, Craig, they're worth almost twice what Toyota is. Tesla currently worth $453 billion in their market cap. And for perspective, GM and Ford are each worth just over $50 billion in market cap. Is Tesla simply a car company, or are they something else from your perspective?
So Tesla's an EV company, and EVs are cars. A lot of people try and dress this up as some technology story. Reality is the auto OEMs are actually pretty sophisticated around technology, and batteries. Tesla doesn't have anything in batteries that the others don't. People like to talk about this 4680 cell that's cutting in. It's a solvent-free production. It came from the Maxwell Technologies acquisition. Actually, the key technology in there is the coder technology that comes from Sauer Essig in Germany, which is owned by Matthews Corp. That's open source. Guys in Japan have bought their coders. People in Germany have bought their coders. The 4680 is not all that proprietary. Other people have the same technology. If they were really so special in batteries, why are they buying from Chinese OEMs? They're not. Tesla's a great company with a great brand that's pushed hard, and you're seeing other leading brands push into this market aggressively. Volkswagen, it's just going to be a couple of years, and they should be quite a bit larger than Tesla in EVs. And that's not the only name.
And Greg, if Musk is on the call, I'm sure he will face some questions about Twitter. We haven't even brought that up yet, just in terms of how big of a distraction that is, how much time he's spending there versus how much time he's spending at Tesla. How big of an overhang do you still see that story being to the stock?
Oh man, that's a tough one. I mean, Twitter really is a boat anchor. It's something he probably wishes he never bought. He probably was a little bit tongue-in-cheek when he made his original bid public. I think he probably views that as just a freaking boat anchor, and now he's going to go out there and fix it. Best scenario for him is if he could get someone like Jack Dorsey to come back. Jack's got $1 billion rolled into it in stock, right? If he could persuade him to come back and win back those 80 advertisers that have left, that would be a huge deal for Tesla. It would probably pop the stock, $25 to $50. The reality, though, is I think that there's enough of a challenge to bring someone like Dick Costolo or Jack Dorsey back, and they'll have to look elsewhere for credible leadership. Given that Musk has said he's going to depart, he's going to go and focus back on SpaceX and Tesla and Neuralink and all the other fun projects he has going on.
Yes, the monkeys. You gotta focus on the monkeys. Craig, there's probably a dozen questions for the call. If you had just one and Elon had to answer it, what is it?
Oh man, what would stop you from taking more price cuts this year, and how would you balance price versus unit guidance for the year? Which one's more important for you?
All right, that would be a good question. Hopefully you'll get to ask it. Craig Irwin, thanks so much.
Thank you.
Well, IBM just releasing its Q4 results. Ines Ferre has that for us. Ines?
Yeah, Shauna, and taking a look at fourth quarter revenue, that came in at $16.69 billion. So that was above expectations. The estimate was for $16.38 billion. Adjusted earnings per share came in at $3.60. That was about in line with expectations. Fourth quarter free cash flow came in at $5.21 billion. And here's some commentary from Arvind Krishna, IBM's chairman and CEO. He said, our solid fourth quarter performance capped a year in which we grew revenue above our mid-single digit model. He went on to say, looking ahead to 2023, we expect full year revenue growth consistent with our mid-single digit model. Now, a headline that has come out is from CFO James Kavanaugh, who gave an interview, who said IBM is going to eliminate about 3,900 jobs. So we have seen in the tech industry job losses. We've seen companies cutting costs by cutting jobs, and IBM appears to be going ahead with the same route, with CFO James Kavanaugh saying that they're going to eliminate about 3,900 jobs. The stock in after hours is slightly higher, guys.
Yeah, certainly a theme that we have been hearing on these earnings calls, or really from many of its peers within the industry. Ines, thanks so much. Well, coming up, we are taking a deeper dive into IBM's results. We'll be right back. IBM shares just above the flat line here in extended hours following the company's earnings release. A beat on both the top and bottom line, upbeat annual sales forecast, also announcing some cost-cutting measures. IBM cutting 3,900 jobs. We want to bring in Future and Research Principal Analyst Daniel Newman. Daniel, it's great to see you again. So first, just your reaction to the job cuts and the beats that we're seeing from IBM on both top and bottom lines.
Yeah, I think the cut are more of a normal part of it. Should be more accepting than ever. I mean, you have a company that beat on top and bottom, making a relatively small number of cuts, but strategic, showing that they're still looking at this year as a bit of austerity. And despite the fact that they did better than most were expected, hey, we're going to take this moment while a lot of companies are making some cuts, and we're going to make some. Hopefully, they're very focused on those strategic, performance-based. But right now, this is just going to be happening across tech. We're going to see it everywhere. And I think it's a moment where a lot of companies that had planned to do it are going to do it today.
Largely speaking, this has been a massive reorganization, kind of like turning around an oil tanker. It takes a long time and a lot of money in their case, $120 billion. But given the S&P is down, 9% in the last 12 months and IBM's up almost 3%, is that turnaround finally complete?
Under Arvind Krishna, the company has refocused itself and it really picked the areas it wanted to get behind. And hybrid cloud and AI were two areas that, as an analyst, I can tell you are a good place to be. They've made some strategic M&A decisions, both inward and outward. The spinoff of Kyndryl was really important for the company to be able to focus on getting back to growth. The acquisition of Red Hat, when they made it, it looked like a big expense, and a lot of people weren't certain, but you're seeing it bearing fruit now. As hybrid cloud continues to be the winning architecture for enterprises, IBM seems to be in a really good position, and they're winning with these higher margins. You see they're growing and expanding margin, but the consulting business, the software business, it's growing across all segments. And it's hard to not feel positive about the fact that a company like IBM has really found its way through. It's been a tough macro, not just recently, but really for the last 6 quarters, to perform pretty well. Arvind Krishna's strategy is taking shape and the company is executing.
Jim, we know the U.S. dollar, obviously very important here for IBM. They generate about half their revenue from overseas. We certainly have seen the U.S. dollar pull back a bit. How big of an impact, or what do you see the effect of currency fluctuations having on IBM this year?
Yeah, I had an opportunity recently to talk to CFO Jim Kavanaugh, and he actually said the FX, which was adjusted in most of the forecast, improved. It was about 150 basis points better than they had originally expected. So this, the acceleration of their business going into the end of the year and the improved situation with FX both gave a bit of a tailwind to the company, but I wouldn't put too much on FX. This has a lot to do with good performance. It also has a lot to do with something I've been talking about for a while, which is what's kind of old is new again. And so IBM is one of those companies that no matter where you are in your sort of cloud and transformation journey, they're very involved, whether it's at the mainframe or all the way down to, next generation public cloud architectures, partnerships with AWS. They're really well positioned. Companies during this year are going to be saying, how do we get more out of the technology we've already invested in? That's part of why you saw such a great number from ServiceNow that just hit. So, the companies that are able to help you automate, to implement hybrid cloud, AI, data, analytics, and be able to do this with more of what you have are going to do well. IBM really fits that mold. So it's not just about a new IBM, it's about having the right offerings for the enterprise right now.
All right, got to leave it there. Daniel Newman, appreciate that, breaking down IBM's earnings. Signs of some recovery in the housing market. Weekly mortgage applications increasing 7% last week, according to the Mortgage Bankers Association. This coincides with 3 straight weeks decline of mortgage rates. Falling rates could mean Americans who held off on buying may move back into this market. 83% of Americans say buying a home is a priority for them, according to a NerdWallet survey. However, the survey also found only 11% plan on buying in the next 12 months, so clearly we need to see some more signs of recovery. Redfin earlier today, Shauna, tweeting out that they are seeing what they believe is the beginning of a turnaround. Some think the worst is still to come, but one of their agents, in fact, said more buyers this month than all of Q4. So certainly appears to be, in many parts of the country, the beginning of some relief. Yeah, certainly. And this is something that the housing market has been waiting for, something that the housing market wants to see clearly, even mortgage rates to fall even further, despite some of that optimistic tone that we're hearing from Redfin. Needham did cut its housing market forecast for the year today. They lowered their revenue estimate for Redfin, also for some of its peers, Zillow and Compass. Needham saying that they're taking a more conservative approach to Redfin's future market gains, especially not even this year, but also next year, looking out to 2024. So I think some questions just in terms of what the housing market, what that demand is going to look like. And we saw that reflected in some of those stocks today. Redfin closing off just over 8% today. So when you take a look at the pressure, clearly that is placing on the stock recently. We have seen some improvement in the housing market. You talk about that activity, but certainly we do have a ways to go. Yeah, surprising that 2/3 of Americans say a housing market crash is imminent in the next 3 years, which is a really strange disconnect because not many who cover this sector are predicting that. Now, there was a lot of talk about Armageddon several months ago, but I think most believe that we're going to be okay. Although I do not entirely disagree with the projections from Goldman Sachs in a note earlier this week. They have 4 markets that they believe are due for a crash, which means 25% decline or more in 2023. They say those cities are San Jose, and look what's happening in the tech environment, all those layoffs. That makes sense. Austin, Texas, where you saw prices just go dramatically through the roof over the last year. Phoenix and San Diego. And I think you could probably add about 2 or 3 others to that list, perhaps Tampa Bay, Florida. I think Miami's going to be okay, but both of those markets up about a 30% increase. So there are going to be some select cities that see that 20% fall in housing prices, but for the most part, I think low single digits.
Yeah, we'll get some more data this week. We have new home sales tomorrow, pending home sales on Friday, so we certainly will keep an eye here on the housing market as we do await more of a recovery there. All right, well, coming up next, we are taking a look at the retail sector here. We will be right back.
LinkedIn says remote jobs made up 13% of postings last month. That's down from 20+%. CEOs like Citi's Jane Fraser talking about bringing back underperformers to the office. So will that return to office bring a return to more formal office clothing? I hope not. Nate Checketts also hopes not. He's the co-founder and CEO of Roan, who they say is the most comfortable men's apparel guaranteed. Nate, good to see you.
Good to see you.
So we changed in the COVID times to these comfortable clothing. Is that a permanent shift in men's attire?
There's no question. I mean, once you get more comfortable, going back is just not an option. But I think what is the next evolution of that is bringing comfort to traditional silhouettes. You've got our commuter shirt on, commuter pants. I mean, nobody would know that you're wearing the most comfortable. You could sleep in that. I mean, it's that comfortable. And,
I could.
I actually ran the London Marathon in that dress shirt, so you could do just about anything in these clothes. And we think that's the next evolution of menswear, is supreme comfort in traditional silhouettes so that you can go to work and still look good.
And Nate, your numbers are so impressive. Taking a look at these, retail sales growing over 200% last year, projected to grow another 242% this year. Are you able to keep up with that demand, and what do those expansion plans look like?
I mean, one of the great things for us is that retail is a growing channel, and we believe that these channels kind of support each other. There's so much opportunity. We only have 9 stores coming out of this year, so growing 200% is absolutely achievable for us. We plan to grow triple digits in retail for the next several years.
Are you not seeing a pullback in consumers that have just been stung by inflation?
I think one of the great things about our product is we invest in what we call value, right? So it's not cheap, it's not inexpensive, but our dress shirts, for example, $128, but you never need to get them dry cleaned. So they pay for themselves. If you're used to paying for dry cleaning, this shirt, you can throw it in the wash, hang dry it. It'll last for a very long time. And so we believe it's all about kind of, like everything else in finance, a good return on your investment.
Everybody talks about Lululemon. There's some other competitors like Vuori. How do you distinguish yourself from those others in the space that is more crowded than it was a few years ago?
The main thing for us is we focus intently on the male customer. So everything we do, from fit to quality of fabric to our technology, we use a technology called Gold Fusion, which is after 100 washes, still 98% effective against odor. Nobody else in the market uses this technology, and that's because we're obsessed with serving our customer. So I think it's about doing things a little bit differently. A lot of people want to talk about the competitors. In our office, we talk about the customer.
Well, Nate, you're making me a bit jealous because I know you just do the men's line. I wish you did women's. The fact that it's so versatile, the fact that it's so comfortable, you could just throw it in the wash. I know you don't do it now, but any plans are you thinking about getting into the women's business?
I think that there's so many players in the women's market. If we were to do it, we have to have a point of view, and we've got to do it better than everybody else. And so that's the challenge for us. And it's not now, but I won't say never. So we'll have to see.
You learned a lot through the COVID pandemic, as most businesses did. You opened your first store at Hudson Yards in New York City right before the pandemic, which is the worst possible timing.
So
what did you learn as a business leader throughout that period?
There were so many lessons, I think mostly around people management. At a certain point, you were just trying to give your team, your customers hope. In the beginning of the pandemic, I remember everybody was sending out these emails like, don't worry, we're taking care of our team, we're closing our stores. And we decided to send an email saying, this is not another COVID-19 email. If you want to read about how we're treating our employees and in our stores, you can go here. But this is about you, the customer. And we sent 30 days worth of home workouts, 30 days of recipes of stuff you could make with stuff in your cupboard, and stuff to watch on TV. And the response that we got from our customers about, again, focusing on them, that was the key for us. And so we really reoriented ourselves as a company to be obsessed with this idea of over-serving the customer.
And certainly evolving during that tough time. When you take into account everything that you have been through as a CEO, especially over the last couple of years, talking about that success, where do you see Rowan 5, 10, 15 years from now?
I hope absolutely to still be doing what we're doing in a bigger way. It's about growing our megaphone. The most important thing for me as a brand, we focus a lot on mental health. So there are so many active brands that focus on physical health, lifting more, jumping higher, running faster. We think that health is not just about your physical health. It's about a full balance there. And so I'm really excited to grow our megaphone and to talk about men's mental health, which we think is a big issue, and think about treating our mental health like mental fitness in the same way that we think about our physical fitness.
Wholeheartedly agree with that message. Real quickly, belt bag or fanny pack, whatever they want to call it, you're a men's brand. Should we be wearing these things?
I'm not a sling bag. You could go with a number of different ways. I think it's a fad. But we've got one, and they're
Oh, you do? I didn't realize that.
You can buy it at our store on our website. We partner with a company called Bellroy that we like. I haven't committed to making one ourselves yet because I'm with you. It's like,
guys, it's so convenient. I'm telling you, once you try it, you're not going to go back.
It's like comfort. I'm telling you, I'm a dad. I've got 3 boys. When we travel, I wear the sling bag. I'm not afraid to admit it. I'm not fanny pack yet.
Fanny packing it.
Not fanny pack.
Shoulder.
I got the sling bag. It makes me feel a little bit better.
I fanny pack it all the time. I have 2 boys at home, and I need everything on me at all times. Nate Chuck, it's great to have you, CEO of Rowan. Thanks so much for joining us.
Thanks.
All right, the Fed is expected to raise rates by 25 basis points next week, and that's good news for short-term savers. One way Americans are taking advantage is through Treasury bills, short-term securities issued by the federal government. Yahoo Finance's Carrie Hennon joining us now for more on this. Carrie?
Hi, great to be here, Shana. My gosh, this is one way to take advantage of rising rates, is to look into short-term T-bills, right? So there's a different, there's T-bonds, there's T-bills, and so you need to get and T-notes. So they all have different periods, but the ones that's the shortest are the T-bills. So they're usually from 4 weeks to 52 weeks in duration. So it's a great way to kind of jump in for a short duration. And the pros of these things are, it's backed by the federal government. You're guaranteed to get your money back. And they're paying rates that are higher than the saving rates at banks, which is no surprise because banks are a little slower. They're quick to raise the rates on your credit, but not so much when you are trying to invest money with them. The interest rates creep up very slowly. So these are beating CDs and high yield savings accounts. So it's a nice, now it can be, it's not for everyone, but one of the great things about the T-bill is that you're not going to pay state or local taxes on these. So this is sort of one advantage, a tax advantage here that you don't get on investing in a CD or a high yield savings account.
So Carrie, how does someone purchase T-bills and what do we need to know about the different methods?
Yeah, that's a great question, Dave. It's a little confusing. There's one way, which is a very simple way in theory, is to buy straight from the Treasury yourself, treasurydirect.gov. And that's, it's a do it yourself. The only tricky thing, it's a little bit harder to set up your account there. Once you're set up, you're in good shape, but it can be a little bit cumbersome to get it set up. This is good in a sense that the minimum investment is $100. Now, the other route you can take is through a brokerage account. And whether it's Fidelity or Vanguard, Schwab, whatever, if you have an online brokerage account, you can set up and buy Treasury bills directly that way. Now, they generally have a minimum of $1,000, and it can be seamless. And if you go through a bank or some other financial institutions, you might have a separate commission on this, but the big guys don't generally charge you if you have a brokerage account there. But again, it is something to consider which way you want to go.
Okay, Carrie Hannon, great stuff. Really appreciate that. Coming up, fast casual chain Dave's Hot Chicken is seeing rapid expansion across North America with a major assist from social media. We'll bite into the spicy details next. Chevron has announced a $75 billion stock buyback and a boost to its dividend. No surprise, shares are popping in the extended trade. The buyback will kick off on April 1st. You can see shares up 2.7% in after hours. The oil major and rivals like Exxon saw big profits in 22 as the price of oil continued to rocket. All right, from a pop-up in East Hollywood less than 6 years ago to what's now the fastest growing restaurant chain in the country. Dave's Hot Chicken was built on a pretty simple premise of exporting the Nashville heat everywhere while spicing things up on social media.
No one loved hot chicken more than my friend Sam. And this juicy, hot, spice-to-order Dave's Hot Chicken would have been his favorite of all time if it wasn't for his other passion, driving with his head out the sunroof.
Stick your head out, Wiggles!
Wiggles, no! Please don't mess up and die before you eat Dave's.
Speaking of spicy, with us now, Dave's Hot Chicken CEO Bill Phelps and co-founder Armin Oganessian and Brooke De Palma. Nice to have you all here. So let's go back to 2017. There was KFC, there was Chick-fil-A, Wingstop, BWW. What was it lacking, Armin? Why did you feel like the time was now to start this chain?
I feel like what was lacking was maybe quality. I mean, me and the other founders were really big fans of fried chicken. I mean, we ate it everywhere we went. But we couldn't really find like this really good quality chicken that was available everywhere, not just in, smaller markets. So the idea behind it was to create really good quality chicken that we could expand across the country and kind of maintain that level of quality.
And Bill, the hashtag Dave's Hot Chicken has more than 150 million views. That one we just showed has more than 4 million views. How does that translate, you think, to the bottom line?
Well, it's the most efficient marketing tool kind of ever invented. Is the social media platforms of Instagram and TikTok give new brands like ours an ability to get incredible reach at very little cost. Most of that 150 million views you talked about are user-generated content. So you have guests walking into restaurants and filming the restaurant and the product, and that's what's our primary marketing tool. So it's an incredibly efficient way to go to market for a young company.
And Bill, I want to stick with you here for a quick question on your growth plans. From 2021 to 2022, you went from 40 to 102 locations. Now you have plans to develop 700 locations. Who exactly is funding this aggressive growth plan, and how does this compare to your previous ventures at Blaze Pizza and at Wetzel's Pretzels?
Well, Wetzel's Pretzels, Rick Wetzel and I knew nothing about franchising when we started this, so we grew at a very slow rate, but we learned the business from the franchisees. And then Rick and Elise Wetzel came up with Blaze Pizza. I co-invested with them, and they did everything right. They brought in a great team, and they were able to grow really quickly. I think they got up to 84 restaurants in a single year, and that was the fastest growing restaurant chain. And then we took their playbook, and we did that here, and we are opening about 85 restaurants this year. We'll probably hit a pace of 100 to 120 in the next year or so.
Let's talk about the hours that these locations are open. Here in New York, your location is open from 10:30 to about 11 p.m. at night. Now, you started as a late night pop-up tent, but how are you supplying, or rather getting labor to stay open that late? And ultimately, when wage prices or wage pay is going up, how are you able to fulfill that?
Well, Dave's is kind of a fun place to work. And it's always hard to find good people in this industry, but our franchisees are incredibly experienced and very resourceful, and they brought in great employees into the industry. And we create an environment that's fun, and so we have much less turnover than your typical fast food place, which is great.
Armin, obviously the food is at the core of everything you do, and I'm going to try this here for the first time, very excited. But how much of building this has been about building a business, building a brand, Armin. How much of a brand is this versus just a restaurant?
I mean, it's interesting to say that because the way we always thought about it is if you kind of focus on what you're specializing in, which is food for us, then the brand aspect will almost come to you, right? If you just focus on producing really good food, then people are going to love it. People are going to come back. They're going to swear by your brand. And before you know it, more people are going to know about your brand. And before you know it, it's big. But it comes down to the food. We're in the food business, so it has to be about the food. The food has to be good because that's what brings people back in through the door.
And I want to follow up on a question on that. Your menu, while it has a few different items, and particularly is related to some tenders, some chicken sandwiches, fries, as I have right here, I want to hear first how exactly you're able to push through any shortages you might be seeing on the menu. But in addition to that, who are your biggest competitors?
Competitors-wise, I mean, you always have your big chicken competitors like, the Chick-fil-A's and the Raising Cane's. But again, we like to focus on our food. We like to focus on, our customer. And the reason we do tenders only is for that reason exactly, so we can maintain a high quality food while still having a high output level. We can see a lot of customers and we know they're either going to order a tender meal or a slider meal, and both of them involve a tender. That way we can kind of prep it and cook it as it's ordered and kind of not keep it under heat lamps and not have it be pre-made. And that way everybody's getting a fresh order as they come in.
The sandwich is perfect. Bill, last question. Celebrity investors like Drake, Michael Strahan, Samuel L. Jackson, how helpful has that been in getting the message out?
Oh, it's just fabulous. There you got the big stars that have incredible following. I think Drake has 125 million followers on Instagram. And so when he posts something, a story, the following is just incredible. I think we got 30 million views of a post he did about free chicken on his birthday. And you can't buy that kind of exposure through traditional media. So it's a great vehicle for us, and it's worked really, really well.
An amazing success story. Brooke, what do you think?
This is very good. I have to say it's juicy. It has lots of spice and the coleslaw, I guess kale slaw, you guys say?
Coleslaw.
Yeah.
It's very tasty.
It is delightful.
Love it.
Really appreciate you being here, Bill and Armin. Check out Dave's Hot Chicken coming to you soon.
Thank you so much.
Thanks, guys. Appreciate that. Cheers. Coming up, shares of Tesla and IBM are moving in after hours trading, but they're not alone. Find out what other stocks are making noise when we come back.
All right, let's take a look at what is trending after hours. First up, let's take a look at Tesla. Those results pushing the stock up to the upside here after hours, up just about 1%. Taking a look at some of those numbers here, is actually a pretty strong quarter for Tesla. Some of the commentary from Tesla just about where they see deliveries going, their long-term delivery growth target there, reaffirming the fact that they will be able to meet that 50% target. That was, of course, a huge headline coming out of that report. Also remaining on track to start production of its Cybertruck later this year. Some other headlines crossing right now that Tesla did enter into a credit pact on January 20th with Citibank. The pact provides for revolving credit line of up to $5 billion, commitments for up to an added $2 billion going forward. Lenders also include Deutsche Bank there. So again, Elon Musk's Tesla there slightly beating on revenue estimates here, and you're seeing that stock pop after hours, Dave.
Net income and revenue up 59% and 37% respectively from a year prior. Imagine what this company would do without the Twitter overhang, without thinking about the personality of the CEO and founder before buying a car. Boy, it'd be a lot like SpaceX, a true rocket ship.
It certainly would be. All right, let's take a look at IBM. That company also reporting after the bell. You're looking at the stock under pressure, off just about 2%. They did beat on the top and bottom lines. Revenue of $16.69 billion, EPS of $3.60. Another big headline coming out of this report, the fact that the company is cutting 3,900 jobs. So Dave, just the latest tech company there to announce job cuts.
Yeah, Daniel Newman joined us earlier, and the big question has been for years, this total overhaul, turnaround of IBM. It has been like turning around a giant gas tanker, and it's cost them $120 billion estimated dollars. But Daniel Newman told us he thinks that transition is finally complete. You're seeing the upside.
All right, let's take a look at ServiceNow. That stock on the move after hours here. You can see it off just about 4.5%, was off just about 9% a few minutes ago. Adjusted EPS for the fourth quarter coming in $2.28. The estimate was for $2.02. The company seeing first quarter subscription revenue of $1.99 billion to $2 billion. The estimate there was for $1.96 billion. Adjusted revenue, $2.03 billion for the company. Estimate there was for $2 billion. Let's take a look at Levi's, another stock here moving after hours. It's up just about 7%. EPS beat during the quarter. Net revenue of $1.59 billion. Estimate was for $1.57 billion. Full year net revenue guidance also coming in pretty strong. You're seeing that stock pop after hours. Again, the retail sector, which many analysts have been bracing for a severe slowdown there as consumers do pull back their spending. That stock, though, beating the estimates, and we're seeing shares up just about 7%. Real quick, Las Vegas Sands out with its results. Taking a look at shares up just about 3%. Revenue of $1.12 billion. That was a miss. A wider than expected loss, adjusted loss of 19 cents. The estimate there was for a loss of 8.5 cents. The CEO in this earnings release remaining very optimistic, saying he is still confident in the robust recovery. Of course, though, that continues to be challenging when you take a look at the Macau business there.
Yeah, the China reopening going to be major for companies like LVS. All right, that'll do it for us today on Yahoo Finance Live. Be sure to come back tomorrow, 3 o'clock Eastern time, for all your coverage leading up to and after the closing bell.